Welcome back to Sectors Made Simple. It is a pleasure to be back here with you all today, and I have an awesome topic to go over with you all. This was a viewer requested topic, and it's something that we covered back in 2020, but the reality of it is 2020 is a long time ago. Also, I apologize, I'm getting over a little bit of a sore throat, so my voice might be a little bit squeaky today, but we're going to power through it. So, order types was a topic that we covered back in 2020, but the reality is our ability to use them has improved, and most importantly, the ways that we can use them with sectors made simple has skyrocketed. So, that's what I want to look at with you all today. We're going to dive into the world of order types, talk about what they are, and most importantly, how you can use them alongside your sectors made simple tools. So, quick disclaimer, I'm going to talk today quite a bit about the world of, well, trades, order types, how we're buying things and how we're selling things, and finally get into some strategies. Please remember, anytime we're covering these topics, they are meant for educational purposes only. The examples I give are never recommendations to go and buy that thing. Instead, it's simply an example that I wanted to use to share and illustrate what I'm trying to cover. So please always do your own research prior to making any investment decisions. Cool. So today's topic is all about order type. We're going to talk about how trading a stock actually works. Silly, I know, but bear with me. Why we might want to use different types of orders, the three most common types of orders that there are, explanations of each of them. Then we're going to dive into the fun part, examples of how each order type can be used and ways that we can use these order types to make trading using the Sectors Made Simple tools simpler. So, diving into it, let's start off by talking about how trading a stock actually works. I know, silly, but this is really important for us to talk about because there's a lot going on behind the scenes from when you press that purchase button or that sell button up to you actually owning that stock. So what happens when you go to your broker and you want to trade a stock, whether it be a buy or a sell? What you're going to do is you're going to ask your broker, go and trade that stock for you. Hey, Juan de los Palotes, go buy me a share of Apple. But to do this, they're going to need to know a few pieces of information. Some of these you are going to actually tell them, and others they're just going to assume. I know what happens when we assume things, but the reality is they're going to. So they're going to need to know what stock you want to trade, if you want to buy or if you want to sell that stock, how many shares of that stock you want to buy, but most importantly, at what price do you want to buy them? This is where things get really, really interesting because the at what price is something that most people don't put. They don't choose what price they want to buy or sell stock at. But we'll come back to that in a moment. First, I want to talk to you all a little bit about the three main order types. Whenever we're talking about orders here, we're talking about us telling our broker to do something for us with our stock. Buy stock for us, sell stock for us. Those are orders. There are three common types of stock orders. In reality, there's a few more than three, but for today, we're going to keep it simple and talk about the three most common: a market order, a limit order, and finally, a stop order. Each one of these order types has its own advantages and disadvantages and has something that makes it unique. So let's go through each one of these, starting off with the one that we're probably most familiar with, market orders. Market orders are probably what you're used to using when you go and you trade stock. If you want to go and you want to buy shares of Apple, you're not going to go to your broker and say, I want to buy shares of Apple for $100, knowing full well it's like $232 in the stock market right now. It's just not going to work. So if I want to go and I want to buy shares of Apple, I go to my broker and I tell them, go buy me Apple. I don't care what price, because the reality of it is, I probably looked at Google Finance, Yahoo Finance, Thinkorswim, whatever I'm using to find the price of that stock. I already know the price, and that is the price that I probably expect to pay. So market order is you telling them, buy or sell at whatever the current market price is. That market price will change over time, but this is how we're used to buying and selling stocks. As long as there is somebody else willing to be the other part of that trade. So if we're buying stock, there needs to be someone selling it. Or if we're selling stock, there needs to be someone buying it. It's not that we can magically throw our stocks into a box and suddenly money comes out or securities come out of it. Well, at least for the New York Stock Exchange. The NASDAQ is a little bit different, and no, we're not going to get into the differences between a broker market and a maker market. Not the point. What we're going to get into here is the fact that market orders are simply you telling your broker, go out and buy me shares of Apple. They ask you for what price, and you hit them with the Monopoly Man little shrug. You have no idea what price, or you know what price, but you don't care, because it's going to be somewhere around the price that you see on Google Finance, Yahoo Finance, insert charting website here. This is really convenient because you don't need to do much prep. You tell them how many shares you want to buy, what company you want to buy those shares of, and you tell them just go and buy it. That's all. So they're likely to complete instantly. Within literal seconds, you can go from having money to technically having stock. But you don't just get the market price. So if you go and you look at the stock for Apple and you look at the price, we did that right now. I'll do that on the other screen just quickly. It's $232.62. That is not the price that I would buy shares at, though, and that is not the price that I would sell them at. Instead, there are two not so hidden, but a little bit less known prices. Because if we're buying a stock, we would buy it at the ask price. Somebody out there in the world is saying, does anybody want to, or they are asking, does anyone want to buy shares of Apple for $232.60? Or $232.68. It could be more than the current price. Or if you are selling stock, it would complete at what is known as the bid price. So for market orders, if you buy stock, you are accepting whatever the ask price is. If you're selling stock on a market order, you're accepting whatever the bid price is. So that's the simple thing. So now let's go into an example. Like I just said, right now, Apple is sitting around $232.62. The bid price is actually a little bit higher. So the bid and ask price will depend on what website you look at. Depends on when they check the market. But the website that I used for this was Morningstar, I believe. And they had the bid price at $232.63, which means if you sold shares on a market order, they would sell for $232.63. The ask price would be $232.67, which means if you bought shares of Apple at market price, they would buy for $232.67. Now, I do want to just quickly talk about the weird situations that can happen. Those bid and ask prices are the average cost of 100 shares, which is why you'll notice that it can be a little bit different than the current price. What that means is that they look at the 100 best offers. The the best offer for 100 shares. A few of the shares might be available for $232.63. Actually, I think the best way to do this is, let me show you exactly what we're talking about. So if we go to NASDAQ and we look up Apple, and we go to their stock quote, down here, we see that is a ginormous ad. Holy. Here we go. Bid and ask prices. The bid price is $232.62 for one share. That might not be very useful to you. So what they'll do is they will now try and find the bid price for the next 99 shares. And they'll keep going until they find the average price of 100 shares. They'll do the same thing for the ask price. But here they make it easy because someone is out there that is asking $232.65 per share for 106 shares. So in this case, we do have the 100 shares for the ask. We don't have it for the bid, so we need to do a little bit of math. Now, does this really matter for a stock like Apple? No. Because there's so many people that are trading Apple that it's really not going to make a big difference. But for a stock that is much less traded, like the newly incorporated, not a real company, Juan de los Palotes Incorporated, that bid-ask price might be completely different. And liquidity, how much stock there is and how easy it is to buy or sell for market price, can be a factor. Most of the time, it's not. One of the few times I think that a casual or just a normal investor would run into issues with liquidity is if you're trading options for some small company. There you might run into some issues, but for this, I'm putting it here just so if someone's worried about it, we've talked about it, but for the most part, you place a market order, it's going to complete at market price, either the bid price or the ask price. But now, that is assuming that I don't know what price I want to buy or I want to sell at is. What if I want to choose? I do have that option. I can choose to buy or sell at whatever price I want. I could sell shares of Apple for $1,000 if I wanted to. No one's going to buy them, but I could sell them for that, or I could try and sell them for that. And this is where we get into the world of stop and limit orders. These stop and limit orders work differently than a market order because you can choose what price you want to buy or sell those shares at. If the current price is better than your offer, what will happen is it doesn't really matter. The order will auto-complete and it will complete at the best offer in the market. So it'll work like a market order. But most of the time that you're setting a limit or a stop order, the reason you're doing it is because the price right now is worse than what you want to buy or sell at. So in that case, which is honestly always, the stop and limit orders will not complete right away and will wait to be completed until the price that you asked for is hit. This is where things get really fun because now we get to say, I don't want to buy shares of Apple for $232.62. I only want to buy them for $230. So I could put in an order that says I will only buy shares of Apple if it goes down to $230 a share. Once it goes below that price, then this order would happen, or what is known as execute. So that order would be executed once what I want to happen happens. And if it never happens, if I said that I only want to sell once Apple hits $1,000, Well, at least I can pass the order on to my grandkids, right? So, stop and limit orders are an amazing tool, and we'll get into many examples of them today. But there is one piece that's missing here. Sorry, grandkids. Time. While it is possible to technically set a stop or limit order for as long as we want, we need to tell the broker how long we want to keep that order active. There are a few different ways that we can do this. The two, well, technically three most common are a day order, which is keep the order. Well, actually, I have the definition later. So we have a day order and then good till canceled, abbreviated GTC. There is a third type of order expiration, but it's not based on time. It's called one cancels the other, or OCO, OCO. For day orders, these orders are active until the end of the trading day. So if I went in right now and I placed a stop order on a stock, if that order didn't complete by the end of tomorrow, that order gets canceled. The other way that we could do it is we could do good till canceled, where if we place that order and we tell them, keep this order until I tell you to cancel it, that order will remain active. So if a week from now, that price target gets hit, that order would execute. And if you notice, there's a tiny kind of attached to this, because many brokers, and honestly, most brokers, will auto expire good till cancel orders after about 30 to 90 days. You can change this, but they do that to prevent you from accidentally buying something or selling something months after you've done it. How many times have we all set a subscription to do something and forgotten about it until we get the credit card bill or anything like that? Your broker tries to help you avoid doing that. So they'll auto cancel the order for you. You can change that though in the settings. The last one that I mentioned briefly is one cancels the other. This is a type of order that can be either a day order or a good till cancel order. But the important difference here is that it is not one order, it is a few of them. It's two or more orders that work together. So I could have 4 orders, and once one of those orders completes, the other 3 get canceled. It's a little bit more complex, yes, but it is still valuable to know because there are some trading strategies, and we'll cover one of these later on, that take advantage of OCO orders. If that means nothing to you or your head's starting to spin a little bit, don't worry. Everything we really think about here will boil down to day orders, or more often than not, GTC or good till cancel orders. So now let's dive into stop and limit orders, starting off with stop orders. A stop order will execute that order, will complete it, if the price falls below a certain price. Kind of redundant, but really all that means is that if the price is going down and it crosses below the trade price, that is when that order would be executed. And it would be executed, well, I'll hold off on that. This order can be a buy or a sell order. It might seem a little silly to say, I want to buy a stock if the price is going down below whatever price I'm telling it to be. But there are instances where you might want to do this. But really, it's commonly used as a sell order. The thing's going down. I want to get rid of it. Sell it if it's losing me money, is essentially what you're telling your broker. I bought some shares of Apple. If all of a sudden Apple starts to go, as my mom used to always tell me, in the toilet, yeah, flush it for me. Make it easy. So stop orders will allow us to have these automated, meaning we don't have to do anything, orders, where if the price falls below that target or that order price, the order will complete. But they're not magic. Remember that we were talking before about bid and ask. The fact that we can't just sell a stock to anyone that exists, or rather to nobody. We need to sell it to somebody. There needs to be someone on the other end of that trade. And this kind of works against us when it comes to stop orders, because the stop order only tells the broker when to trade. I know it's silly, right? It's a price. A stop order is for a price like $200. And when it goes below $200, sell it for $200. Right? Well, not exactly. Because the stop order is really just telling them when. It is just a really overly complex way of telling your broker when to sell. When the price goes below $200, sell. What price? Well, if all you set was a stop order, it would sell at whatever the current market price is. It is telling them do a market order once the price has gone below $200, is really what it comes down to. So it's possible if the price drops suddenly. For example, bad earnings. Earnings are often announced after market hours have ended. If earnings are terrible and the stock's price plummets overnight, if it went immediately from $220 to $170 and you had a stop price at $200, you don't magically get to sell it for $200 because no one's buying it for that. Instead, you would sell it at whatever the new current market price is. So again, stop orders aren't some magic genie in a lamp that is going to always protect you against the worst of situations. They are just a way of telling your broker when to trade for you. Trade when the price goes below my target. And when that happens, sell at market price. For the really smart ones out there, you're probably thinking that's not always how it, yes. There are ways to limit your stops. That's why I said we're covering the 3 most common types of orders. There are more advanced orders out there that will allow us to tell them only stop or only sell once the stop loss is hit and the price is above a certain, those do exist. I do have a webinar from 2020 on order types. I do cover those there if you want to learn more about them. For today, we're sticking with the easy ones. Stop orders, limit orders, market orders. Speaking of, let's talk about using stop orders. Like I mentioned before, they are commonly used to automate selling of a stock. They are just a way of normal investors not having to sit there and babysit their investments, because you can set a stop order to help avoid losses by selling when the price is going down below whatever we want or whatever we're comfortable with. For example, with Apple, the current price is around $232.60. So if I set a stop price at $225, we'd automatically sell when the price falls below $225. Very straightforward. We know that the worst case that we could have is that we lost $7.60. But that's not all that stop orders can do. There are other, in my opinion, more powerful ways of using stop orders. For example, trailing stops. Trailing stops are an amazing thing because there's one big problem with our last example. If we bought for $232.60 and we sold for $225, it means that we are always selling at a loss. That's not great because the point of making an investment is for the value to go up over time. And we want to check, is there a way that we can have this automated sell signal, but still profit some? And the answer is yes. That's exactly what trailing stops can do. The problem with our last example is that we'd always be selling at a net loss. So trailing stops offer a solution. What they do is they have the stop price trail behind the current price. Meaning, if our current price is going up, our trailing stop will go up along with it. This trailing stop can be a dollar amount, or it can be, more often than not, a percent. Percent trailing stops are the most common way that people use trailing stops. So what this will do is it will set the price that we use for our stop loss to some amount below the new highest price since we've created that order. The point here is that if we have to sell the stock, if it's gone up a lot, we can protect some of our profits while still having that automated sell signal. I feel that these trailing stops are best seen through an example. So let's do a quick example. I bought Apple at $232. We're dropping the 60 cents part. And I'm going to set a trailing stop of $15. So my sell price is at $217. If Apple goes down $220, we haven't reached our point yet. We haven't reached our sell price. Our sell price is $217, our current price is $220, and the stop loss will only happen when we fall below $217. Now, if the price goes up to $250, yeah, profit, baby. Now we want our stop loss to change because I don't want to have it go back down to $217. I already made 18 bucks. I'm happy. So if we had a $15 trailing stop, our new highest price is $250. So our stop loss would become $235. And now, all of a sudden, if the price goes down to $240, we're still not selling because our stop loss was from the highest price, which was $250. So now the only time that we would sell is when the stock price falls below $235. Audience participation time. If the stock now went up to $300, what would our trailing stop price be? We have a $15 trailing stop, and our new highest price is $300. What would our trailing stop price, or what would our stop price be? While I wait to see the answers, let's now cover the exact same example but using a percent trailing stop instead. For this one, I didn't want to use Apple's price because honestly, 232 is a really ugly number to start doing a bunch of percentages with. So good old Juan de los Palotes has our back, and everyone is getting it exactly right. It is $285. $300 is the new high price. $15 is our trailing stop. We'd sell if it went below $285. And remember, our buy price was $232, meaning we still profited a ton of money. We made a lot of money on that trade, and we still sold when it began to go down. That's the beauty of trailing stops. So now let's do the same example, but as percentages, using Juan de los Palotes, because $100 is a way easier number for us to work with. We bought Juan de los Palotes for $100. We set a trailing stop of 10%, which means that we would sell if the stock's price falls 10% below its high. That means 10% of $100 is $10, meaning we would sell if the price falls below $90. This is why I used 100. If the price goes down to $95, by the way, not to scale, we would not sell yet. Why? Our trailing stop is 90. We're not at $90 yet. We hold. We hodl. If the price now goes up to $120, what is our new sell price? What is our new stop loss price? I'm kind of prompting you guys a little early here. If you already know the answer, gold star for you today. If not, we'll walk through it together. Our new price, our new highest price is $120. Our trailing stop is 10%. So from that new high price, the trailing stop price is 10% below that. So our stop loss price would now go to $108. 10% of 120 is 12. 120 minus 12, 108. Now, you see what we've done? What we've done is that we've turned our trailing stop into something where if the price goes up enough, even selling at a loss is a net profit. So now if the price goes back down to 110, our stop loss would stay at 110. Sorry, at 108. My apologies. If it goes up to 130, now our stop loss changes again, and it moves up. Stop loss will always move up as the price goes up. It can never move back down because we want it to get hit at some point. So now, using the example we have here, we would sell when the price falls below $108. Stop losses, in my opinion, can be an amazing tool for beginning investors. The reality of it is, unless you want to turn this into a day job, it's really convenient to be able to trade when you want to. You have a couple of minutes at lunch, great, go trade. You have a few hours at the end of your evening, or honestly, a few minutes at the end of your evening, right after dinner, you can make trades then. But selling is something that always worries people. At least for me, I do something called, I marry my stocks. It'll go up a bunch and then it'll start to go down. And then I'm looking at it saying, I want it to go back up. I don't want to sell for a loss. I want it to go back up again. And then it goes down a little bit more. And you get into this feeling of, well, it could go back up, right? It'll eventually go back up. A good way to get away from that is to use trailing stops. Set a trailing stop so it sells when the price is going down and you can't marry your stock. You cut your losses at a certain point and you move on. The beauty of it is stop losses can be applied to any investment, options, stocks, ETFs, and more. And they really can help take the pressure off needing to worry about, should I sell my stock at all? Or if the stock's price falls below my trailing stop while I'm at work, do I have to suddenly run to the bathroom and start going on my phone to sell? No. These orders execute automatically. So if you set the stop loss order, as soon as the condition is hit, you sell for market price and you're out. I use trailing stops since Julie taught us on the radio show. Again, trailing stops are something that can apply to every type of investment. short term, mid-term, or long term. So let's quickly go through two examples of using stop losses with Sectors Made Simple tools at their heart. The first one we're going to do is talking about how we can use a trailing stop using our sector matrix. As a quick refresher, the sector matrix is a way of looking at the stock market and seeing what area of the market is doing the best right now. I did a webinar back in October called What Type of Investor Are You? And we talked about 5 different types of investors, from the aggressive active investor to the I just want to start using my money to work for me a little bit more. One of the strategies that we talked about was a simple strategy that involves our matrix. This strategy goes to the matrix, sorts the momentum by 3-month momentum, and checks to see which sector ETF has the highest strength gained, the biggest number, and buys it. And it holds on to that sector, not for 1 week, not for 1 month. There's no set time that it holds it for. Instead, it holds it until it hits a trailing stop. That trailing stop can be any percent you want. Typical investors will use something between 5 and 10%. The smaller the trailing stop, the less losses, but the quicker it'll be hit. The bigger the trailing stop, now you're risking a little bit more. But means that the trailing stop is not going to be hit as often, giving the stock a little bit more chance to go back up. And it really comes down to finding the balance. What is enough risk, but also enough opportunity? So again, we look at one table, one number, and we can buy the sector ETF that has the highest strength. And at the exact same time we put in the order to buy, we put in that trailing stop order. So when the trailing stop is hit, that ETF is automatically sold. And then, whenever you get a chance, because now your money is in cash, you're just holding cash, you're not worried about that cash going up or down in value too much. Hopefully. So, whenever you have time, you can go in and repeat this process once again. Let's go and do an example of this together. So, as a quick reminder, or if you're new, dash.sectorsmadesimple.com is the home for all of the tools that we offer here at Sectors Made Simple. And as a Sectors Made Simple subscriber, you get access to all of these tools. Our first tool, our first child here really is the sector matrix, a way of comparing 11 different areas or sectors of the market to find which ones are performing the best. We can see who the leaders are right now on this left table. For example, XLC or communications is the top sector. But we don't want to know who the best sector is right now. We want to know what sectors have gained the most strength, which ones are moving positively compared to the others. So to do that, we use momentum over on the right. If you're on mobile, they might be stacked on top of each other like this. Scroll down until you see matrix momentum. Here, what we are going to do, actually, I kind of like the bigger, makes it easier to show. We're going to go down to matrix momentum, and on the drop down where we see previous day, we're going to set that to 3 months ago. Click that, and now positive numbers mean that these sectors have gained strength compared to 3 months ago. Red numbers mean they have lost strength. And just like the strategy says, we click on total, and ta-da, healthcare. XLV would be the sector that this strategy would choose. That's literally it. So this strategy would now buy XLV, healthcare, and hold it and set a trailing stop on it of maybe 5%. Again, the smaller the trailing stop, the quicker that trailing stop will be hit. The bigger the trailing stop, the more time you're giving that ETF a chance to recover. So within 5 minutes, you can come to the matrix, find what sector ETF has gained the most strength, buy that sector ETF, and immediately put in that trailing stop order. And now the rest is up to history or the future. So that's really all there is to that strategy. And that's the reason why that strategy was our beginner investor strategy, looking back at the What Type of Investor Are You webinar. It's very simple. I think when I was doing the analysis, it traded once every few months. And again, rebalancing or going back in and making another decision takes minutes to do. Let's take it one step further. Let's take a look at using another tool within Sectors Made Simple. And this one's going to be a little bit more advanced, but still very straightforward. This strategy is going to use our S&P 500 screener tool. Takes all of the things you love about the matrix, seeing which areas of the market are performing the best, and applies it to the S&P 500. So what we can do is we can find leading companies, the top companies within the, if you want, top areas of the market. So the optional first step here is find what the top sector is. Simplest way to do that, on the S&P 500 screener page, we have a table called sector averages. Sort by total count and see which one has the highest percentage. We can filter the screener to only show companies within that sector. And then we want to see companies that have their price going up and have proven that they can beat the odds and ascend or continue going up beyond where they've been in the past. If you understand point and figure and support and resistance, you'll kind of get where I'm going with that. If not, don't worry. You can still enjoy this strategy without having to learn the ins and outs of point and figure. So we want to find companies who are going up in price and are showing that they are going to new high prices. Their price is continuing to go up over time. From here, we can sort by signal date because we want to find companies that have recently gone on buy signals, recently shown that they are breaking those trends. So what this list is it is the best companies in the optionally best sector area of the market that have their price going up, are beating their old highest prices or their old high prices, and have done so recently. It's a lot of stuff, but it all boils down to a very simple, very easy to follow table. Let me show you before we go through the rest of this. So over here on the left side, we have S&P 500 screener. The first thing we want to do is we're going to do that optional step. What sector is the best sector in the market? So we scroll down to sector strength averages. Click on total, ta-da, communication services is at the top of the table. That's the sector we're going to choose. We're going to go up here, and under sector, we're going to choose communication. So now we've gone from 500 companies to 22. Works for me. Let's now go and let's set those other filters. We want their price to be going up. We want them to be in a buy signal or a breakout. And then this is our list. We have 8 companies. Pretty easy to work with. the last thing we can do, and unfortunately I have to zoom out a little for this one so we can see it all on one page, is if we look over on the right side, we can see what date this breakout occurred. That's the thing we really care about. That's the big sign. They're breaking past their old price, and I don't know what a good analogy for it is. So instead of trying to come up with one, I'm just going to click on this column and show you that we can sort this table to show us what companies have most recently gone on buy signals. And what we see is TMUS, or T-Mobile, went on a buy signal yesterday and is beating 93% of S&P 500 companies. Excuse me. So, T-Mobile. What do we have with T-Mobile? Well, we have a company that is in the strongest sector. Its price is currently going up. It is in a buy signal, and that buy signal happened yesterday. Oh, and also it's beating 93% of other companies in the S&P 500. That's a nice little bonus too. That's it. That can be the end of the decision right there. If all we wanted was one single answer, well, it's the one that went on to buy signal most recently, and it's got a lot of strength going for it. Just to keep things interesting, I'm going to also do the same thing for the second strongest sector, financials, so we can see another example. Here, things get a little bit more interesting. And this is where we start to get into a little bit of fun. Now, all of a sudden, what we see is that we have 25 companies within the financial sector that have a buy signal and are going up in price. We have 7 of them that have recently gone on buy signals: L, PFG, AJD, CME, ICE, FI, and NDAQ. There's 2 different ways we could do this. One, we just look at which one has the highest strength. 2, we look at which one went on a buy signal most recently. In my opinion, the first one is the better option here. But for those that want to get really creative, we take this list of companies. These 7 companies, I'm just screenshotting it so I have a copy. We go here to custom matrices, and we can compare only those 7 companies. So we can compare only those 11 companies to see which ones are the strongest. When you can't make a decision, custom matrices are always going to be your friend. So if we go down this list, we can add in those companies. And then we can get a matrix of only those companies to see which ones are the leaders. Regardless of where you end that process, because really, the tools can continue to be used over and over and over, and it all just comes down to how much time do you want to spend with it. You want to keep it easy? Take the one with the highest strength that went on a buy signal in the last week or so. That's one way to do it. Or take the one that went on the buy signal most recently. Explore, try some different ways, paper trade them, meaning use fake money, see which ones make the most sense for you and give you the best results. But regardless of how you come to your decision of which one you want to buy, custom matrices, eeny, meeny, miny, mo, closing your eyes and pointing at the screen, we can set a trailing stop on it. You can go in, buy that company, and set a trailing stop, so when that price goes down, you don't have to be sitting by your computer ready to sell. So those are 2 examples of ways that we can use trailing stops to help us make trading simpler. And two different tools within sectors made simple, one very basic and one a little bit more creative, and showing off how trailing stops can work into those strategies. So now let's dive into limit orders. Thankfully, there's not as much for us to go over here because they're not as commonly used. A limit order is an order that will execute when the price rises above a certain price. This can be a buy or a sell order, but typically is a buy order. It's very rare that you want the price or that you're waiting for the price to go up to a certain level and then you sell it. Are there times you would do this? Yes. And I will actually cover one of those. But most of the time, you're using this as a sign to buy a company. And again, just like with our stop orders, a limit order only tells the broker when to trade, not what price to trade for. So if the price rises suddenly, your order will complete at whatever the new current market price is. I would go through the example of how a limit order actually works and give prices. The reality of it is, it's the same explanation we went through with the stop order, but we could use trailing limits. They're really never used. Most of the time, you're setting a single price and waiting until the price hits that target. So instead, let's immediately get into our example of using a sectors made simple tool to alongside limit orders. The tool we're going to use now is called swing trade setups. This, I would say, is another step up from the strategies we were just talking about. And again, by me going through all of these strategies, it doesn't mean you need to do every single one. And really, the point is not that you see the one strategy I use and immediately that's the only strategy you do. The hope is that through these different examples, one of them really clicks with you. Or for the more advanced ones, you can see how the tool can be used and apply it to strategies that you're already doing, ways of investing that you have experience with and that our tools can make simpler or more informed. So with that said, let's show off how the swing trade setups tool can be used with limit orders. What we're going to do here is we're going to find a company that is approaching its point and figure buy price. Unfortunately, I think the slide broke a little bit. We'll see. Yeah, it broke a little bit. So what we can do is that we can use the potential breakouts setup for this. Remember how before we were looking at S&P 500 companies and finding ones that have recently gone on breakouts? Here, we're trying to be faster. We're trying to find the companies that might go on a breakout so that as soon as they do, we can scoop them up and be along for the ride. So what we can do is find one of these companies and set a limit order to buy that stock if the price goes above its resistance barrier price. The goal is that we can set that buy order and it won't complete until that buy signal happens. Let's do an example. If we go here, by the way, just for completeness, let's check out our matrix of the financials companies. And what we find is that FI is the strongest of those companies. So out of that list, that would be the one that I would buy if I could only pick one. But now let's go into swing trade setup. This one, getting it all set up properly is really tricky, so bear with me. Click on setup type, potential breakouts, and we're done. That's literally all you have to do. From here, we can filter by sector, just like we did for the S&P 500 screener. So I could go in here and only choose communication services companies. I could choose companies that are going to be on a new buy signal, so breakdown, and whose prices are currently going up. 6 companies. That's pretty manageable. Now let's go through them. Personally, $1.75, it might not be a penny stock, but you know what? Inflation has been a little wild. $1.75 is a little bit too close to a penny stock for my taste. $5.50, yeah, that's not terrible, but the problem is that it's 10% away. Its current price is 10% from that resistance. Again, I don't want to have to wait until retirement for that buy signal to be hit. So instead, I might pick something like MSGE, who is only 2.7% away from its buy price. So here, I could go in and set a limit order to $37. So when that buy price is hit, it immediately executes the order. Now, personal opinion here. You might want to set, or we might want to set that limit price slightly above that resistance barrier, not at the resistance price. The reason is that a lot of people like to do strategies like this. Do they have as good of tools? No. But using support and resistance is a fairly common trading strategy. And if a lot of orders are going to happen right at that price, some mean investors out there might try and profit off of that. So they'll try and raise the price really quickly, get all of those orders to execute automatically, and drop the price as a result. This is something that happens all too common, to the point where they gave it a name. It's a bull trap. Takes all of the bulls, investors that want the price to go up and are waiting for that breakout moment, and it traps them. They buy in and immediately get caught in the trap, and the price falls. One way to avoid this is set the limit order price slightly above that resistance barrier price. Now, the other thing about this too is, what if I didn't want to just be waiting with money sitting there for doing nothing for MSGE to hit its buy price? What I could do is I could set limit orders for ATHM, for MSGE, and for SSTK. I could go in and I could add financials companies. Okay, now we got a bigger list to work with. So I could go in here and add BMO. I could go in here and add whatever list you want. And what we can do is set OCO limit orders. Again, now we're getting much more advanced. So again, if all of this is starting to run away from you a bit, don't worry. The point here is to show what the steps might be from the beginner strategy all the way up to the most advanced stuff. So finally, with these different companies, we can set limit orders for all of them. And if we set them up as OCO orders, once a single one of those companies' buy signals is hit and that order executes, cancels all of the other ones. Meaning, we can set a buy signal or limit orders for 10 companies, but only worry about buying one, which really is probably what we're looking for in most cases. The final thing that I quickly want to chat about is something that is somewhat uncommon, but I'll show off how this can be done with Sectors Made Simple, which is the ability to use both a stop order and a limit order. It is possible to set both types of orders on one company. This is typical in something like swing trading or short-term strategies, where what we want to do is not only sell if we're losing, but we also want to sell once we've made a certain amount of profit. So you'll see people say, I have a stop loss and a take profit. Stop loss, sell because we're losing money. Take profit, sell because we're making money. In this case, we would set two orders. A stop loss to try and avoid losing too much money, so putting a cap on how much money we can lose, and a limit order where we can capture realized profits, where we've already made our money, we don't want to give it the chance to go back down, and we want to have that cash to do other stuff. So we've made our profit and we sell out and take that profit. Again, these are slightly more uncommon, but once again, our swing trade setups tool, much like the name says, can help if people want to get into swing trading. Here, we are looking for companies that are not at or past their support or resistance. Instead, they are between their support and resistance levels. So their resistance is on top, the support's on the bottom, and the price is somewhere in between them. Depending on what position we want to take, you could go long with stocks, you could buy calls, or you could go short, most commonly done through put options. We want to make sure that the company has enough room for us to see our profit. So if we know our take profit amount is 5%, we want to make sure that there's 5% room for us to have the price go up. Because remember, resistance and support are valuable because a price is likely to encounter trouble or change directions at those barriers. So what we want to do is let it get close to that barrier, take our profit out, and let the price do whatever it's going to do from there. So we can find the right level of risk and reward using the swing trade setups. We can set filters so we only see companies that have a certain percent from resistance. So here you could say, I want it to be greater than 5%. Well, I would do that if there was a company that had greater than 5%. So I'm going to do 3%. Or it's just not going to cooperate. Oh, that's from support. Let's try this again. 3%. So there we go. Jonathan's good at using the tools that he developed. I promise. So now what we've found is we've found companies that are 3% or more from their resistance. So if my take profit margin was 3%, these are the companies that offer me that 3% take profit without hitting their resistance. Again, now we're really getting into the more advanced ways of using the more advanced tools. And this, again, is where a lot of personal experience can start to come in. But the reason I want to show it is because these are features that these tools can use. And if this is a type of trading that you want to get interested in, or get into, or try out, our tools can do that for you. So you can set your take profit and stop loss percentages and check companies that offer those percentages without hitting support or resistance. Or keep it easy. Use potential breakouts or breakdown filters to find stocks close to those barriers. And finally, now we get to talk about both our stop and limit orders. Use the support and resistance prices or a price near them as our stop and limit prices, so you don't need to be a day trader to be a swing trader. There is a lot of information that we've covered here today. We've covered strategies ranging from the simplest strategies to the most advanced strategies. And the reason that we've done that is to show that really there is something here for everyone. Stop and limit orders can benefit traders of all skill levels, just like Sectors Made Simple's tools can benefit traders of all skill levels. If anything you've seen here today is interesting to you and you want to explore it more, but want a little bit of help, please send me an email. This is stuff that I love talking about, and one of the best ways that I can provide education to you all is to learn how you're using the tools, what topics you'd want to learn more about, and discover how Sectors Made Simple can help you invest simpler. So, if you ever want to reach out to us, have a chat, or ask a question, or, like today's topic, request a future webinar topic for me to cover, please send me an email. My email is support@sectorsmadesimple.com. Until next week, thank you all so much for joining us today. It was such a blast to be able to cover this topic with you, show off a little bit more about our Sectors Made Simple tools, and make the world of investing a little bit simpler for us all. For our Spanish community, para nuestra comunidad de hispanos, recuerda que vamos a tener un webinario de SM Español este jueves. Espero que nos vemos allí. Thank you all so much. Always a pleasure to be here with you all, and we hope to see you all back very soon. Take care.